India has cut gold import duties from 15% to 6%, alongside, for the first time since 1990, repatriating the first tranche of 100 tons of gold from the Bank of England. Now, a move to repatriate Indian gold reserves stored at the Federal Reserve, good luck with that, is reportedly underway. Now, this repatriation request will cause a problem for the Fed. Now, one way or another, this is bullish for gold. What it's doing is drawing attention to first-tier physical gold being segregated from high counterparty risk ETF and derivative gold. Now, India's onshoring is just one more move by all the global central banks to repatriate their gold ahead of the BRICS currency launch.
Physical demand also played a role in gold's performance this week. India's decision to slash import duties on gold and silver earlier in the week boosted physical demand, with gold premiums in India jumping to their highest level in a decade. This increased demand potentially offset some of the price decline. AndrewMaguire is an experienced independent metals trader with over 40 years of experience in the financial and precious metals markets. About current trends, AndrewMaguire notes that India is lowering gold import duties and repatriating gold, reflecting a global trend among central banks to secure physical gold ahead of the BRICS gold-backed currency launch. Central bank buying has driven the rise in gold prices since 2022. According to JP Morgan, gold could be entering a strong era, as central bank purchases of gold in 2022 were more than double the average annual purchase across the decade prior. In his assessment, AndrewMaguire explains that China has quietly converted a substantial part of its hidden $3 trillion reserves into physical gold. He predicts that gold prices could surpass the estimated target when this information is revealed, potentially becoming the new price floor. China's treasury notes and bonds holdings have dropped $440 billion since the end of 2017. During this period, the balance of the securities held in Belgium, widely seen as a home to custodial accounts for the Asian nation, increased by $159 billion. China's holdings of U.S. stocks, agency bonds, and other debt also rose, suggesting that the nation might have shuffled its dollar assets rather than cutting them. Consequently, Maguire predicts a gold revaluation by the Sino-Russian alliance could trigger a global shift, elevating gold to a new asset class. He suggests the Fed may need to revalue its gold holdings or risk exposure if other central banks repatriate their gold. Now we present the clips of AndrewMaguire's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Now, what's becoming clearer, though, is that China has, through their secretive shadow banking operations, been stealthily converting a large percentage of these hidden $3 trillion of largely dollar FX holdings into physical gold. Now, once this is ultimately revealed, the price of gold will far exceed Goldman and the 5 first-tier banks' estimate of between $2,700 to $3,000 per ounce in 2024, likely placing $2,700 as a floor, which is Goldman's target, as a floor to rally off. Now, if needed to be invoked, the nuclear option would be for the Sino-Russian alliance to announce they're about to or have already announced a revaluation of their gold reserves, which, to avoid a related internet currency breakdown in the other global central bank currency crosses, which they're all interconnected, it would trigger every other global central bank to also revalue their central bank gold reserves. And that is a process that we've been through before. It is simply can be done with a click of a mouse. Now, what the central bank does is simply sell their existing undervalued gold revaluation account gold holdings. Let's just say at what liquidity providers kind of figure it's likely around $1,900. It's been raised from 12, 13, 14 to about 1,900. That's pretty much for where the European central banks are. And then into a bid-only market, immediately what they do is sell it, rebuy the same number of ounces back at market at, say, $2,500 to $3,000, instantly crystallizing a gold asset gain, bolstering their GDP gold correlation, which would be supportive of their currencies. And looking, really kind of, that would cement a new floor for the price of gold. Now, notably, at this point, every single central bank, without exception, would benefit from a higher gold price. Now, clearly, this process was once and all for eliminate non-Basel III compliant paper gold as a tradable asset class. Now, as we previously assessed, only backdoor for the Fed to avoid exposing the degree of rehypothecation of the reported 8,133 tons of Treasury gold would be to also revalue gold from its current Treasury price of $42. Whatever the price, it'd just be done. Whatever the price would be revalued is where the Sino-Russian alliance revaluation price settles. Now, if they don't, every other global central bank would repatriate their gold, bankrupting and exposing the Fed's gold rehypothecation fraud. As we all, and we're not the only ones of that opinion, is that the gold may be in the Treasury vaults, but how many ownership claims are on it? That's the problem. But as of yesterday, the heat turned up on the Fed. In a race alongside every other BRICS bank to secure as much gold as possible ahead of the October BRICS gold-backed currency launch, India has cut gold import duties from 15% to 6%, alongside, for the first time since 1990, repatriating the first tranche of 100 tons of gold from the Bank of England. Now, and more to come. They're going to repatriate every ounce. A move to repatriate Indian gold reserves stored at the Federal Reserve is reportedly underway. Now, this repatriation request will cause a problem for the Fed. Now, one way or another, this is bullish for gold. What it's doing is drawing attention to first-tier physical gold being segregated from high counterparty risk ETF and derivative gold. Now, India's onshoring is just one more move by all the global central banks to repatriate their gold ahead of the BRICS currency launch. Repatriating gold is a major component of the race to de-dollarize into rising geopolitical escalations and the associated sanction risks.
During the interview, AndrewMaguire expressed that based on the current trends in the physical gold market, liquidity providers anticipate gold reaching $3,000 per ounce by the end of this year. He states that recent Federal Reserve interventions push gold prices higher, forcing them to buy physical gold to meet central bank delivery needs. Gold's blistering rally this year was partly fueled by expectations the Federal Reserve would cut interest rates as many as 3 times in 2024 as stubborn inflation started to ease. However, current projections suggest that only one rate cut will be penciled in for the remainder of 2024. Despite unbacked CTA positions and a Fed misstep at the 2,000 level sparking a $450 gold rally, Maguire notes that global solid central bank buying is complicating the management of these cycles, potentially setting a higher price floor. Let's get back to the interview.
Let's look at the underlying physical market footprints we see actually developing shorter term and why every first-tier liquidity provider sees gold at $3,000 by year end, or at the very latest early next year.
So let's pop over to the 4-hour charts to take a little bit of the chart chatter out. And if you remember, last time we talked about the 2 Fed interventions here. Here's where the Fed intervention came in, and guess where we bounced? So in other words, it looks like we're forging a new higher stair step. So into the period where CTAs chase the long side with the Fed agent banks 1-to-1 on the short side, what is missed by many analysts is that while these synthetic COMEX-centric CTA long positions are only 4% backed, following the Fed's misstep in overshooting the identified central bank bids we'd identified back down here at 2,000, remember we looked at this before, and that was into the February options expiry, forcing them to buy physical at market to fulfill central bank delivery obligations they did not have sufficient CTAs to short cover into to offset their backfiring short sales. So, in essence, they're really restricted to how many CTAs they can suck in before exposing themselves to physical delivery obligations. This was a breach of the 2000 level. What did that do? It forced a $450 rally with freshly unbacked CTAs enjoying a free ride, actually, without getting rinsed out. This is a change in behavior. Now, what we're looking at here very quickly, we're looking at each of these cases are options expiry events And where do you think we are here? Another options expiry event. So it's a synthetic chase. Now, this is where the SHFE contract kicked in. So when these kind of situations happen, and we've just did breach support, a spot support central bank bidders at 2,400, what happens here and what's happened every time is the Fed is forced to buy gold at market to fulfill backfiring delivery obligations. And of course, this is on the 1st of March. The Chinese futures SHFE exchange was open to citizens who are better, and unlike the Western-facing actors, these actors are betting on a government-backed higher gold price. Meant that the COMEX CTAs have been partly responsible for the velocity all this time of the gold rally. This is an interesting situation. Because while the physical markets are increasingly setting the gold price, rinsing out these tailgating unbacked longs has become much more difficult, as it is seen into every subsequent bearishly based OCC COMEX options expiry. We talked about those in the past. The OCC bets are FX related and in the billions, and the COMEX options are also related to that. So each time we see these wash and rinse cycles, it is to protect these derivative bets. And in this case, they've been rallying from the June options lows. But little do they realize they're unknowingly underpinned by strong global central bank buying, whereby last Wednesday, so strong was the upside momentum, it risked driving a higher physically anchored stairstep at 2,500 spot being crystallized, and that would be a full week ahead of the mark-to-market event tomorrow, which is options expiry.
Some investors buy into the hype around gold bullion as prices rise, pushing them further. The fundamental factors that have fueled gold's rally are expected to continue being a significant positive influence in the future. As we consider these trends and predictions, what do you think the implications will be for investors and the broader financial markets if gold continues its ascent? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.